U.S. stock markets are focusing on tech hardware constraints today. Reports indicate Nvidia scaled back its upcoming Rubin Ultra chip design due to TSMC packaging defects, while major clients move to custom silicon. We look at this hardware shift, along with global value opportunities and late summer correction rhythms.
Nvidia reportedly canceled its original 4-die Rubin Ultra chip design. The massive configuration faced substrate warpage using TSMC's chip-on-wafer-on-substrate L packaging, forcing a pivot to a dual-die model. While this limits single-chip scale, Nvidia plans to reclaim performance using rack-scale configurations.
The market is re-rating Nvidia from a total monopoly to a dominant oligopolist. Major hyperscalers like Google and Amazon are actively diversifying to custom ASICs for their workloads. This shift suggests Nvidia faces a mature, competitive market rather than unchecked dominance.
Away from U.S. megacaps, investors are assigning a near-zero probability to China's success in the AI race. The MSCI China to U.S. ratio has reached an all-time low, showing extreme geographic bias and capital concentration in the United States. But China holds distinct structural advantages. It has low-cost, open-source AI models and controls critical mineral supply chains needed for chip hardware. This divergence suggests a major relative valuation gap for international investors. In value investing, Michael Burry's Scion portfolio has been accumulating former growth compounders like Adobe and Lululemon. These companies are trading at multiples equivalent to 2009 lows, as investors focus on short-term AI disruptions over durable cash flows. Adobe's fundamentals contrasts with the disruption narrative. The company raised its full-year revenue and earnings targets despite stock weakness, and its AI annual recurring revenue tripled to over $500 million. Lululemon shows a different path, lowering its full-year outlook. While international sales grew 16%, North American net revenue declined 3 to 4%, showing domestic consumer fatigue is hitting premium retail. Investors need a selective filter for 52-week lows. Meta has compressed to 16.7 times earnings despite a projected 21% growth rate, whereas Nike faces structural margin drops and a sharp earnings downgrade. In credit markets, widening spreads are driving mark-to-market declines for business development companies. This causes short-term price drops, but it also creates higher yields for new loans, signaling a transition to higher future profits. The broader market remains highly concentrated. The United States now accounts for 65% of global developed stock market capitalization, which is historically high relative to global economic output. Historical rhythms point to a consolidation. S&P 500 performance in midterm years typically features a summer drift on low volume, followed by a double-digit correction in August or September. The playbook requires watching Nvidia's support levels while the index remains below 7,370. Focus on hardware constraints, select value pecks like compressed growth compounders, and prepare for late summer macro volatility.